Hello everyone, welcome to my channel after a long gap. Today we have brought to you a new topic on customer onboarding and customer identification program. So this is again a part of your AML KYC learning module, and this is a very important topic to understand for people who works in the KYC projects, AML KYC projects. People having interest to know more about KYC related topics would also find it useful. So coming to our today's topic, customer onboarding. Let me just give you a bit of glimpse about it. Customer onboarding is nothing but the process where a bank wants to know its customers before it opens the door for them. This is as simple as it is. So now many people might think onboarding means only collecting documents like your Aadhaar, PAN, passport, driving license, company documents, so on. But in banking world, onboarding is much bigger than that. It is about answering four important questions from it. But just think from the banking perspective, you need to ask who is this customer? Is this customer genuine? What risk does this customer bring to the bank? Should the bank open the account, reject it, or ask for more checks? So just imagine it with the airport security. The boarding pass in the airport security, the boarding pass alone does not is not enough. Your identity, ticket, baggage, and behavior all matter. Similarly, in banking, the customer's identity, document, address, risk profile, sanction screening, and ownership structure all matter. So now that we know why this topic matters for us, let's define the customer onboarding properly. So as I said, customer onboarding is a process where basically banks try to understand who the customer is before before the bank establish a relationship with them. So this customer onboarding is a complete process by which a financial institution establishes a new relationship with a customer. It starts from your first application and continues through identity verification, due diligence, risk assessment, and finally account activation. So onboarding is the first AML control point for the bank. Now why is it so? Because if a criminal enters the banking system, with fake or weak information, then every later control becomes very difficult. For example, if a fraudster or if a scammer opens an account using a slightly modified name, wrong date of birth, and temporary address, later the transaction monitoring system may generate alerts, but the investigator will struggle because the base customer information itself is poor or collected wrongly. So it is like building a house. So if the foundation is weak, painting walls beautifully will not save the building. Similarly, the bank if the bank does not perform the onboarding properly, or if the onboarding is weak, expensive ML system cannot fully compensate later. However, the funny fact that I believe is people like Vijay Mallya, Nirav Modi, and similar others never got caught in this kind of onboarding process. So onboarding data is used by many downstream systems. For example, the core banking system, AML monitoring system, sanction screening, CRM applications, cash management application, data warehouses, and regulatory reporting. Now let's move from general onboarding to a specific regulatory concept called CIP. So CIP basically stands for Customer Identification Program. So this CIP is actually a part of bigger KYC process. It's a part of a KYC process. So in US, it comes from the USA Patriot Act and FinCEN's CIP rule. But do not think that CIP is only applicable for the US-based banks. Even India has RBI KYC Master Direction. UK has Money Laundering Regulations Act. The EU has anti-money laundering directives. So different countries use different rules, but the basic idea is the same. The basic idea is know who you are dealing with before opening the door. So CIP usually has 5 major actions, as you can see on the slide. First is a collecting information or collection of information. For an individual, this may include your name, date of birth, address, ID number, contact details, nationality, and so on. For a business, it could be the legal name of the business, the registration number, address, directors, and beneficial owners. Second is a verification. So the bank need to verify the identity provided by the customer using reliable methods. Third is checking. So it is required to check the customer against the government list, sanction list, PEP list, and internal watch list. Then fourth comes retaining the records. So banks must keep evidence of what was collected, how identity was verified, and what decision was made. Fifth, in some jurisdiction, banks need to notify the customer that identity verification is required. So also don't get confused between the CIP and KYC. Like I said, CIP is a part of KYC process. CIP is about identifying and verifying the customer, and KYC is a broader framework and includes understanding the risk, purpose of the account, expected activity, and ongoing monitoring. Right? Okay. Now, before applying CIP, before applying the customer identification program, the bank first needs to know who actually counts as a customer. And in this slide, basically we answer uh, a very practical question, like who requires the customer identification program or KYC. So a customer is usually someone who opens an account with a bank, who opens an account, who opens a new account or starts a continuing relationship with the bank. For example, um, an individual customer opening a savings account clearly requires a customer identification program. A company opening a current account also requires KYC and additional checks. But someone simply cashing a check may not always require full customer identification program depending on the bank's policy and local regulation. A person buying a one-time product may require limited or event-based check. So think of it like a guest entering a hotel. Someone asking for directions at reception is different from someone booking a room. The person looking a room must provide the ID and details because the hotel is establishing a relationship. Now, if someone is a signatory on an existing corporate account, the bank must perform um, CDD, customer due diligence, before because that person can operate or control transactions on behalf of that particular company. Now, for one-time wire transfer, sender or recipient, the rule depends upon the transaction value, and country-specific regulation. Also, if an existing customer adds a new product, the bank may not repeat the full KYC from zero, but it must check whether the old KYC is still fresh. If it is outdated, a refresh might be required. In a real banking world, defining customer scope is very important. If the bank applies full customer identification program to everyone, operations would become slow. But if the bank applies CIP too loosely, again it will create your regulatory risk. So it's very important for a bank to apply CIP properly, appropriately. So for each journey, product, or channel, keep your question very clear on who the customer is, what relationship is being created, and what level of KYC is required for the customer the bank is dealing with. Now, as we know who requires customer identification program, the next question is how does the bank verify the identity? So bank usually verifies customer using two methods. One is the documentary verification, the other is called non-documentary verification. So it's very evident from this two terms. Documentary will definitely involve documents, and non-documentary will not involve any documents. So documentary verification means customer provides a document and the bank reviews it. For example, for individual, this a document could be a passport, driving license, a national ID, Aadhaar, PAN, or voter ID. For business, a document could be a certificate of incorporation, a partnership deed, memorandum of association, or board resolution. Okay, the bank checks is the document. The bank will check is the document genuine, is the document updated, updated. Does the photo in the document match with the customer? Does the name match? Is the address acceptable? So such kind of queries basically bank checks Bank does a check with the customer. Then we have non-documentary verification, means the bank uses independent data sources to confirm the person or the business. For example, a credit bureau data, electoral roll, utility databases, government registries, your biometric verification, and digital identity platforms. So documentary verification is the customer saying, "Here is my ID." So in documentary verification, customer just shows you the ID, and non-documentary verification, in this case, bank says, "Let me check independent sources to confirm this." Um, the gold standard is not only one method that should be applicable. The best approach is the combination of the both. So, for example, capture the document, verify the person, and cross-check against the reliable databases that are there in the outside. So, in digital onboarding, this becomes even more important because the customer is not physically present in a branch. Now, what should a bank do when it cannot verify a customer's identity? So the bank cannot simply say we could not verify, and we will just move on. So bank can't just ignore it. So regulators expect the bank to make a documented effort. First, the bank must request additional documents. For example, if one ID is unclear, expired, or insufficient or not available, the bank may ask for another ID or address proof or utility bill. Second, the bank can use non-documentary methods. In simple words, this means checking independent databases, government records, credit bureau data, or other reliable sources. Third, the bank may apply risk-based hold. For example, the account may be opened with limited activity or limited features. Maybe the bank may allow only the credits to the customer. I mean, the deposit facility to the customer, but withdrawals are blocked until verification is completed. This is usually used for low risk customers and only if policy allows. Now, fourth, if the identity still cannot be verified, the risk is significant, and the bank may have to decline to open the account. And finally, the customer's behavior. If the customer's behavior looks suspicious due to fake documents or refusal to provide ID, or keep changing their circumstances, the bank may have to file a SAR. So, in our previous video, I have already told about what SAR is. SAR is suspicious activity report. Okay. Now, let's walk you through the onboarding journey, the customer onboarding journey, uh, uh, which um, which is very much evident in the real banking system. We'll see the end-to-end onboarding workflow here. In the step one, it's the application receipt. So the customer applies through a branch, through a website, a mobile app, or through relationship manager or business banking channel. So this is the gateway of this entire onboarding workflow. So customer has to apply. After the customer application is done, the next process is to collect data. The bank captures the key information such as name, date of birth, address, government ID proof, number, contact details, occupation, income, nationality, product requirement, and so on. Step 3 is, once the customer data is collected, then comes the verifying the customer's identity. So here the bank performs documentary and non-documentary checks. In digital onboarding, this may also include liveness detection and facial matching. This is like your live video KYC, which are being done nowadays by the banks. Then after identity verification is done, then it will go for screening. The customer has to be screened against sanction list, PEP list, adverse media, internal blacklist, or sometimes fraud databases to check whether the customer is involved in any kind of fraud activity, whether the customer is himself a fraudster or a scammer. So this kind of screening has to be done before the establishment or before establishing a relationship with the customer. Then comes a risk assessment. So the bank assigns based upon this multiple checks that the bank does. The bank will do the risk assessment here. The bank will assign a risk rating, whether that customer falls under low risk category, medium risk category, or high risk category, depending upon various factors like the geography, occupation, product type, customer type, source of funds, and definitely screening results. And finally, The last step is the account activation, or the opening of that particular account is successfully completed. So if this checks are passed, the customer record or your customer information, CIF number basically, is created in the core banking system, and the account becomes active for the customer to use. Now this KYC, actually, if you see this part, um, this middle part, this is the this for workflow basically, is a part of KYC. So KYC, again, KYC is not, so you have identified a customer and that's it. This is not a process. KYC is not one-time event. After your onboarding is done, after the bank onboards a customer, still the bank must keep refreshing the customer information on a periodic basis, or when any trigger event happens. For example, if a low risk customer suddenly starts receiving international transfers from a high risk country, so the bank system may trigger a KYC review. So that's when the bank will again have to be in touch with the customer to collect the KYC or update the KYC details. So far, we have mainly discussed the individuals, but business onboarding adds another layer of complexity. Now this slide compares the individual onboarding with the legal entity or business customer onboarding. For an individual, CIP is relatively straightforward. The bank collects basic identifying information like full name, date of birth, address, government ID proof. Then it verifies the key documents such as your passport, driving license, some national ID card, etc. But for a business, things become more complex. The bank must verify the legal name, the registration number, the business address, the place of incorporation. Um, it also needs documents like certificate of incorporation, articles of association, trust deeds, and so many. Now here's the important part. For an individual, the person themselves is usually the beneficial owner. If I am going to open an account for myself, I am the beneficial owner. There is no complexity in that. But for a business, the bank must identify the ultimate beneficial owners. In simple words, these are the real people who ultimately own or control the company. So that's a very complicated task for the bank when they have to deal with the business or entity customers. Now think of it like this: a company is the mask, but the bank wants to know the real faces behind the mask, right? Then the bank also has to verify the directors, the beneficial owners, um, the authorized signatories, because these people actually control or operate the account on behalf of that business. So an individual onboarding, because of less complexity, an individual onboarding may need only one or two documents. One or two documents will be sufficient for individual onboarding. But business onboarding may require tracing through multiple ownership layers, especially if there are parent companies, subsidiaries, trust, or complex structures. For business organization, CIP is not complete until the ultimate beneficial owners and the authorized persons are properly identified and verified. Because criminals may use shell companies to hide ownership, that's why entity onboarding or business onboarding requires deeper checks than your individual onboarding. Now, let's move to the modern world where onboarding is no longer only branch based. It has gone totally digital. So earlier, a customer often visited a branch, met a bank employee, submitted documents to that employee, and physically signed forms. Today, customers open accounts through mobile banking apps or mobile apps in a few minutes. This is, I mean, very useful for customer experience, but it changes the KYC challenge actually. On the opportunity side, it actually gives you brings you opportunities to discover, and also brings new risk in this digital onboarding process. On the opportunity side, the digital onboarding allows your automated ID documentation, ID verification, biometric matching, faster processing, then few drop-offs, better audit trails, and instant database checks. For example, a customer uploads an ID, takes a selfie, and the system compares the photo with the document. It may also check whether the person is alive through blinking, head movement, or liveliness liveness detection. But then this looks very seamless and smooth, but then there are risks also involved in it. So synthetic identity is one major risk. This means the fraudster combine real and fake information to create a believable fake identity. Then deepfake attacks are another challenge. Fraudsters may try to bypass video verification or facial matching. Account takeover risk also increase if weak authentication is used. However, digital onboarding does not mean lighter or less stricter KYC. Digital means KYC must become smarter. So digital onboarding looks for smarter KYC process. It also talks about automation. Digital KYC promotes automation, and it's better controlled. Right? So regulators expect banks to maintain strong controls even when the customer is onboarded remotely or branch or wherever. Now, onboarding is totally dependent on the data quality that the bank and its systems are getting or collecting from the customer. Let's talk about some common yet critical data issues at onboarding. The first issue is name standardization. The same customer name may be written in multiple ways: full name, initials, spelling variation, shortened versions, or transliteration differences. This basically lead to sanction match failure. So sanction screening fails because of this particular issue. For example, Muhammad Al Rashid may appear as M Al Rashid, or it may also appear as Muhammad Al Rashid, or there could be 10 other variants. So this directly affects your sanction screening. A true match may be missed because the name was stored inconsistently. The second issue is address validation. So free text addresses create downstream problems. One person writes wrote, one person may write wrote, another person may write wrote in short, then another person may write landmark based addresses. So good system look for standard address lookup or structured address field. The third issue is the date of birth format. This is a very classic problem actually. So for example, if you see at this particular address, so is this date basically mean 3rd July or 7th March? So if systems do not enforce the correct format, duplicate customers and false matches may appear. The fourth issue is document expiry tracking. A passport collected years ago may now be expired. Right? If the system does not trigger refresh, the bank ends up with the stale KYC records or outdated KYC records. So this few data issues become AML issues going forward. So duplicate customer keys, missed sanction matches, incorrect risk score, failed KYC refresh, and regulatory fighting often start from poor onboarding data. Okay, now that we understand the data quality, let's look at common real world issues seen in the banking projects. The first issue is evergreen KYC profile. This means a customer was onboarded many years ago, but the bank never refreshed the information. So the customer's address might have got changed, the customer might have changed his or her job, income has changed, risk profile has changed, but for the system, it still shows the old data. Then this becomes a regulatory time bomb. The second issue is over reliance on a document. Some banks may only check whether a document was received, but they do not properly verify whether it's a genuine one. A scanned document is not automatically we cannot consider a scanned document as a valid document. Third issue is channel inconsistency. So branch, mobile app, website, and business banking may capture different fields in different formats. So this creates downstream data quality issues. Fourth problem is the backlog. So a bank launches a product quickly and allows accounts to become active before CIP completion, customer identification program completion. 6 months later, thousands of accounts require remediation. This is going to be a very painful, costly, and risky affairs. The fifth issue is non-documentary data failure. So some customers may have a thin credit files or limited database history. For example, a young adult, a new immigrant, or people recently got divorced. So the bank must have a policy for alternative verification rather than rejecting a genuine customers unfairly. So these are exactly the areas where BA got an opportunity to add value by defining the business rules, by defining the exception path, mandatory fields, workflow triggers, data standards, and remediation processes. Okay, and with this, we come to the end of this video. I hope uh, that the time you have spent on watching this video won't at all go in vain. If you really learned from this video or like this video, do hit the like button and subscribe to my channel to remain updated with the new videos whenever I upload. See you in the next video with a new topic. Till then, goodbye.